I'd like to invite you to hear about what it's like to be an investment banker. Sorry for the 5-minute delay. Can you, yeah. What we're going to try to do today is I'm going to tell you a little bit about myself, and after that we're going to run through what it's like to be an analyst or an associate at an investment bank, and then try and run through what we do for a living. What are our days like? Then I'm going to run you through a couple of deals. And finally, we're going to try and understand what are the skills required to be an investment banker, both soft and technical. Before I start, I'd like to talk a little bit about a moment when I realized that this was something I wanted to do for the rest of my life. I think it was we'd been working on this deal for a few months, and I'm going to run you through that deal later. I'd just come back from the UK. We'd found the company that we wanted to buy, and we'd come back, and I was sitting here. I'd been working long nights trying to put together a deck that we'd use, put together offers that we'd make for the company. We'll talk you through all of it in a little while. And at this point, my boss at the time, and I was an associate, we didn't really have that many client interactions up till then, came up to me and said, I think the deal is off. And for someone who's been working on this for close to 3 months and had given up at Diwali, that wasn't really something you wanted to hear. And I said, why? And I said, they don't have the money. And I said, what do you mean they don't have the money? I mean, how does that even happen? And then he turned around to me and said, they don't have the money. Things fall through. And I said, and then I went home, obviously crestfallen, because this was my first key big transaction, and I wanted to see it through all the way through. And I had an idea. And I remember when I was visiting the company, there was something large on their balance sheets. And because as associates, we tend to do a lot of the work on the annual report. To cut a long story short, I went back the next day and I said, what about this? Why can't we use this and collateralize this? And he said, yes, but that's in India. The company we're buying is abroad. And I said, but why can't we securitize this and do a few other steps, do an LBO, and that company has the money, etc., etc. And he turned around to me, and I was 26 at the time, and he said, okay. And in a few hours, I found myself on a plane to the UK with a deck I had prepared on the flight, which I will share with you, going to meet bankers in London to finance my deal. And at that point, I realized that this is something I wanted to do, because something I said, work I did, had immediate impact, and people were willing to listen. So today I'm going to take you through a little bit about the world that is largely misunderstood in terms of what we do. People think it's about numbers when it's really not that much about numbers. People think you need to be an accountant when you don't really need to be an accountant. But what you do need to be is open, adaptable, and hardworking. So let's begin. What we start with is I want to spend a little bit of time trying to tell you what we actually do as investment bankers, which someone seems to not many people seem to know. Hi, I'm here again. What I'd like to spend some time doing right now is to try and tell you what we do. Now, a lot of people think that investment banking and investment banker are the exact same thing. So the question I'm going to ask you, obviously it's not very interactive here right now, but rhetorical, is a trader who works in an investment bank like Goldman Sachs an investment banker? If not, then who is an investment banker? Well, we go back to what investment banking really is and how investment banks began. Investment banks essentially began doing a very, very small part of what they do today, right? They began as advisors in the 1920s, men like Lehman Brothers, Sachs, very smart men decided that they were good at analyzing companies, they were good at investments. And as they made investments and as they started to have clients, they began to put two and two together and organize companies and introduce companies. And soon they found themselves raising money for those companies in both form of private and public equity. They began helping companies go IPO. They began helping companies raise funding, and they began helping companies buy other companies. And so began the M&A shop and the corporate financing shop. And this is the heart of investment banking. And these are the folks who are called investment bankers. Soon as they got larger, they began to add divisions. They began to add, they became traders, so they had trading divisions. And as you know, traders today, Goldman Sachs would have proprietary trading and normal intermediate brokerage services. Then they began to have research houses because they realized that people wanted to know how they were making so much money. They wanted their brains on a piece of paper. They had equity research houses. So this is where equity research comes in. They had fixed income. They had commodity research houses. They were starting commodity research, fixed income research. Soon they started to branch out. And then they started moving into different, then you have PE. And then this is completely different, of course, from commercial banking, which is your ICICI Bank, your HSBC Bank. This is investment banking. So it's very clear to understand, very important to understand what it is I do for a living. I do two things. I help companies buy other companies. I help companies sell their company. I help clients sell their companies to other companies. I help companies raise money, both in form of private and public equity. Private equity, of course, you all know what private equity is these days. It's all the rage. If it's a tiny client, it's just a platform that's starting. Let's say a Flipkart from 6 years ago. I would go to a VC, which venture funding, and all of this is, of course, taught in detail in the Imarticus EY Fabric course. So I won't spend too much time on it. And then, of course, if they're larger companies and they need growth funding, I raise money through private equity funds, large private equity funds like Indian funds like Risk Capital, or 3M, or Walker Pincus, or KKR. And of course, I raise money to help companies raise money through the public markets. And that would be through the IPO, initial public offering. And finally, of course, I sometimes can act as an advisor. Okay? So essentially, that's what I do for all for all practical purposes. With this in mind, I think we should move on to what an associate and an analyst does, every day. So most people come into investment banking when they're an analyst. Typically, you get hired out of post your graduation. Once you graduate, you finish your BCom, or you finish your BSc, or be Bachelor in Arts. There is no prescribed requirement in investment banking about what you study in your undergraduate. If, of course, you join an investment bank, after that you join as an analyst. If you join post an MBA, you often or not join as an associate. So in most MBA finance, if you're out of IIM, if you're out of ISB, you'll most likely join as an associate. And so when you're, and then of course after a few years, an analyst to an associate takes about 2 years, and beyond that, of course, an associate takes about 3 years to move to senior associate, or an AVP, an assistant VP, and so on and so forth. So now I'm going to kind of take you through what a typical day. I mean, of course, the anecdote I shared with you earlier is not perhaps a typical day, but here are some things you can expect to do as a typical day as an investment banker. Most investment banking shops, and here I'm going to throw a few names as well, so you can use this as an opportunity to send your resumes. Of course, there are two types of investment banks. There are bulge bracket banks. Bulge bracket banks would be anywhere from, even Edelweiss would be counted as a bulge bracket now. So Edelweiss, you would have Goldman Sachs, you would have, to some extent, JP Morgan, to some extent ICICI. And of course, what's the difference between a bulge bracket and a boutique is that a bulge bracket does a lot of other things. They do trading, they do research. They can actually be BRLMs, book running lead managers for IPO. Whereas the other kind of investment bank is, of course, the boutique investment bank. Boutique investment bank primarily deals only in M&A and fundraising. So typically, associates and analysts have slightly different days if they work for a bulge bracket versus they work for a boutique investment bank. A bulge bracket investment bank would primarily work on Excel sheets and decks. In either case, be it in a boutique bank or in a bulge bracket bank. But as an associate, this is when things change significantly. Associates in investment banks, bulge bracket investment banks, tend to continue to do Excel and PPT decks, whereas associates in boutiques like Aventis Capital and MAPE 03 tend to do a little bit more. And here I want to take a little bit of a diversion and talk about a little bit about me. I am an investment banker and I work in a boutique, so I'm slightly biased to how boutiques are run. I think they're smaller shops. I've been an investment banker for over 10 years now. I primarily started my career post ISB. After that, I joined a treasury house in Delhi, and post which I joined Aventis in their industrials team. So I built up their industrials team. They're a very small company at the time, and industrials team in that I specialized in manufacturing. So that's another facet of boutiques, in that you start to specialize quite early. So I'm a specialist in industrial engineering. That doesn't mean I'm an engineer, and we will talk a little bit about the requisites you need for investment banking a little bit later in more detail, but you don't need to be an engineer. I focus primarily on manufacturing. You can choose your focus, and rather you get told what area of specialization you're going to be in: consumer goods, pharmaceuticals, FMCG, and of course, these days, the most coveted team to be part of is e-commerce, and everyone knows why. In fact, you'll be happy to know so that boutique banks are leading the way in terms of e-commerce transactions. So as I was saying, it's slightly different. Your day is slightly different if you're in a bulge bracket or if you are in a boutique. But regardless of where you are, you start your day quite early. You start it at around 7. You're going to put on the news, find out what's happening in the markets, and if you haven't worked all night, you can maybe get in an hour late, but you'll be in by about 9:30. Most analyst associate meetings happen at around 10 because most clients walk in at around 11 or 12, and so there's a lot of preparatory work. So a lot of the time your boss will walk in and he'll ask you to put together a brief profile of a company. A brief profile would be something like, give me 2 slides on XYZ company. I have a meeting with them in 1 hour. So you put aside what you're working and you do that. That means you try to dig up information, you go to the internet, go to the website of the company, try to dig up information, and you put together as much information as you can, in as succinctly as you can, as brief as you can, that it makes sense and it's coherent, and that you can get ready. If you are, of course, in a boutique, a lot of the time you can actually join the meeting. Most of these meetings tend to be about, if they're initial meetings, they tend to be about strategy. What do I want to buy? Should I sell? Or could be if I want to raise money, how much money do I want to raise? If it's an initial meeting, they're what you call feeler meetings, and it's best to be with them at this point. And note-taking is critical skill. It's something we teach in the Imarticus EY-FAB program, how to take notes, because those are essentially the most important information you get is from a meeting. So you spend most of your morning with clients and colleagues. After that, while your boss is in a meeting, you sit down with your team and discuss the schedule, perhaps what time, which presentation should be in. Lunch and afternoons are usually for collecting data, scheduling updates. If you're, let's say, working on a PE deal, you might start working on your deal tracker. A deal tracker is how many PE firms have I contacted for this particular transaction? Have they responded? Is my deal hot? Is my deal cold? Often we have to give our client updates on a regular basis, usually every 3 to 4 days if it's in the beginning. How many PE firms have come back? Have any PE firms come back? Is your company a dud? Of course, we never tell them their company is a dud, but if nobody's shown interest, maybe we need to change our strategy. Maybe we need to say something better about the company. Maybe we need to change the marketing documents. And of course, night, well, our days do not end at 5 o'clock. In fact, the joke is that our days often start at 5 p.m. and because for some reason, all the work seems to come into the desk at 4 p.m. So the evenings are usually spent on projects, on things that are required. Everything is urgent in investment banking, like we actually said. The reason everything is urgent is because company financials are dynamic. And I will talk you through that when I talk you through a deal, but numbers change every day. As you know, a company is making a certain amount of money today. That balance sheet will change tomorrow. Inventory changes. The numbers change. A company might be doing extremely well today, and tomorrow they might wake up and find that they don't have the order book that they thought they did. And therefore, you need to work accordingly. So a lot of the time, we're constantly making changes to what we call is deal collateral. Collateral is all the documentation work that we put together as an investment banker. Again, something you will learn in the EY-FAB course, how to make investment banking collateral. We make a lot of changes to that on a regular basis. We put together collateral for a pitch presentation. Often somebody would come in, your boss will come in and say, it's a Friday evening, your pitch needs to be done. So we spend a lot of time gathering information. And of course, early, we submit the reports. We try to get the boss to look at, or my associates come and try and get me stuff as late as I can. So if I'm going to be leaving at 7:38, they try and get something to me at 7, so that I don't have to look at it at 10 at night. And of course, we spend the night, or associates spend the night making changes to everything I've told them to change. Which is, of course, again, when I talk about prerequisites to investment banking, is you really need to love what you do because you spend a lot of time doing it. So that, in a sense, is a day in the life of an investment banker. We spend a lot of time working on PowerPoint, working on Excel, reading and researching. So you can spend 3-4 hours just delving deep into how the auto component industry is doing, or studying the strategy of Flipkart for 2 hours if you are planning to make a pitch presentation for another e-commerce company. What exactly did Flipkart do? What did they get right? What did they get wrong? Or what did Snapdeal get wrong, so that it doesn't happen to your client? Or why, for instance, the Flipkart for the failure in the talks, why did that happen? And perhaps use it to better, create knowledge base on why things haven't happened, so that you can be of value to your client, which is your first and foremost objective of your job. If you create value for your client, he will come back to you, and you will have a client for life. And that's something we've discussed in client relationships. So now that you know a little bit about what we do, I'm going to spend some time talking you through some actual deals. Before that, run you through the responsibilities of a financial analyst. Of course, why do I run you through the responsibilities of a financial analyst? Because what we're doing primarily all the time is analyzing companies, industries, and numbers. We're analyzing. So our first thing is, of course, we essentially determine the viability of investments. We're constantly reading, we're constantly ensuring that deals are on track, or how to do a deal, or putting together execution plans on how to do a deal. We are perhaps recommending companies to buy to our client, and of course we interpret data affecting investments. What is a company actually going to follow through on the profitability forecast that they're going to make, and therefore is the company going to be valued as that. Now we're going to quickly move on to an actual deal that I did. And so for this, I'm going to give you a quick run through on the transaction. So this was the transaction I was talking about earlier, where this was a company that was a borosilicate glass company. Of course, I told you I'm an industrials vertical, and borosilicate glass is a scarce product. Scarce means obviously that it's a fairly expensive product. While scarce means that it's always valuable, it also means that in the entire universe there's not that much you can do, because there are only 5-6 companies that produce borosilicate glass. And following which, if you are the only 5-6 producers, you will learn when you do a Porter's 5 forces, and we teach that in EYFAP, that there are certain power struggles that happen between supplier and resource. And if you're only one of the 4, for instance, you have a certain amount of clout. So being one of the few borosilicate manufacturers in the country, this client had the opportunity to buy a company in the UK. So what happens at that point? Once a company decides they want to buy another company as part of their inorganic growth strategy, inorganic means you are growing your revenues by acquisition, by buying revenue rather than by creating it organically, which is through your own resources and through your own projects. Okay, so because borosilicate glass market is so small, they knew the only way they could grow was to either buy a competitor, and since there are only 4 or 5 in the world, that would be pretty tough because they're the smallest, or you would go and buy down your value chain. So you would either buy upstream, which means you can't go any back because you produce the glass, you are the raw material, which means the only way is to go forward or forward integration into your customers and the products. Okay, so they were approached to buy a company that manufactured laboratory equipment in the UK. The first thing that happens when it happens is, of course, they decide whether can we do it ourselves. Often, the reason you have an investment banker is the investment M&A works just like any other sales for practical purposes. It's usually by auction. So I'm sure if some of you have ever followed the Tata Chorus deal, that was an auction, right? You actually tell the world, or tell the world, meaning you tell the world's companies, I'm up for sale, come and bid. And it's bidding in itself and managing an M&A transaction is an acquired skill set. It takes years of experience of understanding how to negotiate, understanding how to read the numbers, what to take at face value, what questions to ask, and how to value, what bid to make. They are borosilicate manufacturers, glass manufacturers, and they don't know anything about corporate finance, so of course they came to an investment banker, which is me and my team. As I said, I was an associate at the time, I was quite junior, and I attended this, and because we thought it was a fairly small transaction, we when they put someone like me in charge, which was nice. And so I worked directly with the boss, and we were then sent to the client, and we got a book. This book is usually called the information memorandum. Okay, so I'm going to take you through from the first thing. Now, because this deal was happening in Europe, we of course we partnered with a firm over there, and we partnered with a firm over there, and of course put together a valuation range. What I'd like to talk you through is, the first thing we do is we get an information memorandum. An information memorandum generally has a lot of information about the company. It has its financials, and a management discussion that discusses the financials. Okay, so we have to put together what we call a bid presentation. A bid presentation is something I do in terms of a bid presentation is a PPT that I put together to advise my client on what to pay for the company that he wants to buy. This essentially means, as you can see here, I'm going to use my cursor to show you. We look at top line numbers, we analyze them. To give you an idea of how dynamic our world is, I got the information memorandum on the evening of a Friday, and I had to put this together in literally one day, which means you go through the entire memorandum, you forecast the numbers, you look at the numbers that have been given, and you value the company as much as you can, which is why valuation is a key skill we need to have and is of course taught goes in very, very deep in your EY FAB program. We look at it, we get a summary of the top line numbers, we look at business points to note, which means do they have any special real estate, what are the 5-6 main things that make this company shine and why should you buy them, but also what are the 5-6 things that come to me as a risk. And a commentary on their financials, it's had lackluster growth, etc., etc. Has it done well? Are the margins? I can't spend a lot of time on it because it's confidential. But here's a quick idea of what we do. The second most important thing, of course, we get into what we've been hired to do immediately, which is valuation. Valuation in investment banking is done in primarily 3 ways. We have income-based, 2 ways to begin with. We do income-based approach, and then there's the market-based approach. Income-based approach is, of course, using the cash flows, forecasting cash flows, and valuing the net present value of future cash flows, bringing them to here and giving a value to the company. And of course, the second way is market-based, in that you use comparable transactions that have taken place in the field, or you use comparable multiples of listed companies in that sector and come to a valuation. On that basis of that, we come to a valuation. We decided to use EBITDA multiple comparable transactions. We decided to use EBITDA multiple listed companies. EBITDA, of course, is earnings before interest, tax, and depreciation. EBITDA multiples are relative multiples. So EBITDA multiple would be the EBITDA multiple would be the EV over the EBITDA. What that multiple is of the comparable transactions. Okay, so which means if the EBITDA of a company is 10 and the value of the company is 1,000, the EBITDA multiple is a certain multiple. The EBITDA multiple comparable transactions, EBITDA multiple listed companies, which means what are the companies trading at that are listed, what are their EBITDAs, what are the enterprise values, what is the multiple. And we take that average multiple and then we apply that multiple to the EBITDA of the company that we're valuing now. That's called relative valuation. And of course, we do a DCF. I won't go into detail of that. DCF is a discounted cash flow, where we use forecasted cash flows. We bring the net present value. We calculate the cost of equity, cost of debt, which gives us the weighted average cost of capital. We use that weighted average cost of capital, and we find the net present value of all the cash flows, which gives us the DCF. Using that, and of course, this is the kind of data that we given when we talk about this is a bubble graph. We always take as much data as we can when we try to get averages. We look at medians, we look at means, and we put together a deck. And this is called a bid document. And when we do a DCF, we have to quickly document our assumptions, do a sensitivity analysis, and we come to, this is what we call a football field, which means we compare all the valuations and we tell our client that this is the value of the company. X is the value of the company. After which we tell them this is, but if X is the value of the company, do you think that's what we're going to bid at? Obviously not. We know that we would then, of course, lower that to ensure to give us some sort of buffer when we bid. And that buffer could be, if this was valued, let's say, if we decided that we're going to value this company at around 70 million pounds, then we would start at maybe 58, 59 million pounds enterprise value. Enterprise value, as you all know, is market capitalization plus debt minus cash. Of course, why market capitalization? Why not market cap versus EV is something, again, you will be taught in the EY CAP program. And of course, following that, we also have to talk them through and tell them who's your competition? Who else is going to be bidding for this similar company, because we need to understand how much money they have, so that we know how much to bid and how aggressive they are, so that we know what number to put across. And then we bid. It's very, very simple. Once we bid for the company, how do we bid? We essentially put together a small something called a term sheet, or a bid offer letter, which is essentially a very simple letter talking about who we are, how much money we have, who we are, how much money we have, and why we should be the ones to buy this company. Very much like a marriage proposal, except the person who's, it's even better, because the in-laws, you'll never ever have to live with in-laws ever again, because you're buying the company, right? But the important thing for you to understand here is that all of this is what we call in the air. We haven't done anything. Nothing is binding. So when we put together a letter, it's like anything else. It's like a love letter. It has no value until the deal is actually done. But it does show intent. It shows intent to buy a company at this value. We do. And once that goes through, we sit and wait. So we sat and waited, and a couple of weeks later, we were told that we have been selected as part of 4 companies who will be put through the process. The process usually means, the second step in the process is that we are given information through a virtual data room. A virtual data room is, in the olden days, or rather even today, data is physically kept during transactions in a locked up room, which filled with files, dusty files that you aren't intended to sit through and either file if you're an investment banker or go through if you're a lawyer or an accountant. Today, all that data, especially because we can't fly PwC or a battalion of accountants or a battalion of lawyers to London, that would be much too expensive. We have something called a virtual data room. A virtual data room is, to millennials like you, is a no-brainer. It's essentially a repository of information in a secure site where everything is uploaded, and we get access to a little bit of that because we're in the first stage, and we get invited to go to the UK. So we get to the UK and we spend about a week running through the different plants. Now, this is a laboratory equipment manufacturer, so they have plants in beautiful parts of the country. We travel with my client. My client was a very old man, who was a very sweet man, who kept calling me Bidya, Bidya, for the whole thing. We traveled with him. We traveled with some of our team. So the investment banker, as you saw it now, is the only person who is the only conduit between your client. The client never actually speaks directly to the company that you're buying for anything other than ask questions about the business. They don't talk about valuation. They don't talk about anything that's sensitive. They ask questions regarding the business, and therefore we are accompanied by 2 people from marketing, from production, to assess the manufacturing plants, and of course my client and me. We do that. These are called site visits. Site visits are a very important part of old world investment banking. Obviously, and even today, if you're going to buy Flipkart, or if you're going to buy Amazon, they have warehouses. You'll be surprised how much physicality there is even to an e-commerce firm. To you, these companies are internet pages, but behind them there are buildings and warehouses, and to a large, to something like if a Britannia starts selling online, it's an e-commerce portal, but there are manufacturing sites that you have to go, where the actual work gets done. So there is a lot of joy, and if you like manufacturing and you like assembly, there's a lot of joy in going through a manufacturing plant and seeing how things are made. That's one of the reasons why I loved being in the industrials team. And it's the same if you're an FMCG, if you're in pharma, because you then get to go to pharmaceutical plants. If you're, so can you imagine how amazing it would be to be at Cipla? If you are in robotics, robotics firms in Pune, you get to see how robotics are done. If you're in machine making, so this is essentially in my mind the reason why it's golden, why investment banking is so great, because one week it's one company and another week it's another company in another place altogether creating fabulous products. So one of the reasons why investment banking is great is because you're never stuck doing the same thing. Every deal is different, every day is different. So of course, once we finish looking at the site, we go through the next stage, which is what? You bid again. And this time, depending on how much you like the company, if you find anything wrong or right, the bid goes up or down. In our case, unfortunately, the bid had to go up because my client fell in love with the company. He thought this was the best thing that had ever happened to him. And this stage is often called winner's curse, which is something that happened to Tata because they ended up paying 45% premium over what they should have paid. Winner's curse is essentially, I've got to have this no matter what, which is like the worst thing that can happen. Great for an investment banker because you get paid and the deal goes through, but not great for clients because they then end up paying more and none of the synergy that they had initially thought of actually follows through. And I think I'm running out of time, so I'm going to be very quick now. And so you end up, and he loved this company, and then we of course bid again. And we bid further and further until we made it to the top 2, which is when what happened? We found out that our client had no money. What happens then? Financing, once, this is the crux of it. This is where deals fall through. We bid, you're at the final 2, it's really up to who has the money to put, who has the money in place. So when I found out, when I was told that there was no money in place, we had to go find the money. And we decided to do the following. So this is how M&A deals are often structured. Give me a second and I'm going to show you. Usually structured in 2 ways. If your company is, for instance, a beautiful company like the one we had, which means it has no debt, it is beautiful, full cash flows, making great profitability. I think their EBITDA margin was like some 21 or 25%, I don't remember. Actually, here it is. What's the gross margin? No, I don't have the margins here. But if their margins are great, then of course what you can do is an LBO, a leveraged buyout, which is essentially you are borrowing on the cash flows of the company you are buying. And I will tell you how this is structured generally. But the problem we had was, yeah, sure, we could borrow, but we could only borrow half the amount because the bank that was helping us buy this company would turn around and say, but you need to put up some cash. You can't just buy this for free. So a little bit of history on LBOs. So LBOs goes back to a time in the 1980s when, in 1970s, 1980s in the US, when companies, American companies, were flush with cash, and they found that, and we will again go to this in detail in the EY FAP course. They found that beautiful companies with no debt that were completely funded by equity, all you had to do was change the capital structure from equity to debt, because debt is obviously significantly cheaper than equity, and you could get a massive ROE on your money, and therefore began the LBO. So they had buy these companies by funding their acquisition by borrowing money from banks against the cash flows of the companies they were buying, and you had what we call the management buyout and the leverage buyout. And of course, that's what we were doing here. So to quickly take you through, I decided rather, as a 26-year-old, to do an LBO, which is essentially where I would borrow money against the land of my company, of my client here. I'd put half of that money into a overseas SPV here, right? You can all see the overseas SPV. I'd put my money into this overseas SPV. I'd then borrow another half of the money and put it into the overseas SPV, which means the overseas SPV obviously has all my money that I need. That overseas SPV then buys the company, gives the money to the seller promoters, and the overseas SPV and all the cash flows from the company I buy go up towards the overseas SPV and pay for the and the cash flows go towards paying the bills on the money I have borrowed. Okay, this is a classic LBO structure. Of course, I did all of that. I financed it. I got the funding in place, which is really quite fantastic if you consider we only had 2 weeks to get it all in place. We put together the transaction, and they bid £5 million above us, and we lost the deal. This was about, of course, it was I was again gutted. It was my first real transaction, my real M&A, and it didn't go through, primarily because we as good investment bankers advised our clients to not pay that much money. Because we had valued the company at 70 million pounds. 75 was stretching it, 81 would really not be worth our while. And that's the reason why most mergers fail. So we are not the sharks that we are made out to be, but not, I mean, as much as, let's not get into that right now. But what we're trying to say is that there is a responsibility, and it's not fiduciary, but to your clients to advise them because they trust you on what that you know a little bit more than they do in terms of how much they can afford to pay. Which brings us, of course, to client relationships. Client relationships are what breaks or makes investment bankers. I am still in touch with these clients now. A client relationship in investment banking, deals last, especially these days, up to a year and a half. You spend a lot of time with these people, and your client relationships are based primarily on two things. One is your ability to connect with them. Your client relationship is based on one thing, to be honest, value. How much value do you bring to your client? That is both in terms of your knowledge, your ability to negotiate, your knowledge about corporate finance, and of course, to your awareness, which is what brings us to keeping abreast with new data and trends. You are nothing if you don't know what happened in the market this morning, and because that helps you connect the dots. Though if I didn't connect the dots, I would have known once we failed in this transaction. I still kept abreast 2 months later of all the deals that were happening in my sector, which was now the borosilicate sector, and I knew another company was selling in Czechoslovakia. So therefore, what did I do? I called up my client and told them this company is going to sell, let's go buy this company. If I hadn't kept abreast of trends of what's happening in the borosilicate market industry, if I hadn't kept abreast of trends of what's happening in the world in general, you have to be able to connect the dots. And this is why it's so important to be abreast with new data and new trends. Two, of course, now we're getting into why there's some of the technical skills. So of course, you need to have a keen understanding of accounting. You do not need to be an accountant, you don't need to be a CFA or a CA, I am neither, but you need to have a deep love for numbers, and beyond that love, you need to have a keen understanding on how numbers work, how financial statements work, how they meld together, and this, of course, is what comprises our first level in the EY FAB program, where of course, there's no one better than Ernst & Young and Imarticus, who've been doing this for a long time, to tell you how to tear apart accounts, how to put together financial statements, and how to make sense of the numbers, how to interpret numbers to understand what we teach you in level 2, which is how to value companies, which is what we do, right? We value companies, be it for IPO, be it for M&A, or be it to raise money. And valuing numbers means analytical skills. Valuing numbers means analyzing how an industry is doing to understand how it's going to do in the future, so you can forecast P&L so that you can value the company now. Very simple. It's all. It's essentially spending time to understand how industry works, how numbers work, and how valuation works. Beyond that, of course, you also have to be proficient in Microsoft and in Microsoft Excel and PowerPoint. Again, something we spend a lot of time in the E5FAB program. Modeling is critical to being a financial analyst and an investment banker. You don't get anywhere if you can't put together a model in the space of 3 hours, which means you need to understand basic functions. It's actually, nothing is a closed book, right? Everything is an open book in investment banking, in that you always have access to data, you always have access to research. No one is putting you in an exam situation saying, okay, you need to know the Kaplan formula now. You need to, without anything, calculate a beta. What you need to be able to do is be fast, because speed is of the utmost essence. Speed is what's going to get you promoted. So you need to be fast with Excel. You don't need to know macros. You need to know basics. You need to know how to do an IRR. You need to know how to do a multiple. You need to know how to ensure you can calculate the CAGR in 10 seconds. You also need to understand how numbers work in terms of how to add quickly, how to divide quickly, how to multiply quickly, because that helps you show off in meetings, which helps you get promoted. That's a secret. But you need to know numbers, and you need to be able to remember numbers. You're only going to be able to remember numbers, and you can't learn them off by rote because there are too many numbers, is if you study numbers all the time. And if you're familiar with Excel and familiar with, you'll be able to understand how numbers work, and you won't freeze when you see an Excel sheet, especially when an Excel sheet has close to 30 sheets that filled with assumptions and documentation, etc. You also need to be very good at PowerPoint, because PowerPoint is our bread and butter. Our information memorandums are on PowerPoint. Our collateral is in PowerPoint. Our bid presentations are on PowerPoint. So your ability to actually get the client depends on your ability to make a beautiful PPT that conveys what you want to say and conveys the skill you have. Of course, we've already covered this. Behavioral skills, ability to make decisions, and ability, communication, interpersonal. Everything is teamwork in investment banking. You work in a team. There is no I in investment banking at all. I mean, I'm going to do the cliche, there's no I in team, but really there is no I, because you work as a team. You get clients as a team. Because deals are so complex, you need to have different people with different skill sets, someone managing the clients, someone managing the collateral. Complex problem solving is more a question of you're not going to be, there's no beautiful mind going on here. It's essentially the ability to understand information and connect the dots. And of course, negotiation and persuasion. How are you going to sell a company worth 50 million pounds for 100 million pounds? Is your ability to build that company up. Marketing is critical. Marketing skills are critical. Work-life balance. I'm sure after everything I've told you, you've understood that it is not a 24/7 job. We're not doctors. But what we are addicted to what we do, which is because we do what we love. We are open to taking calls at our hours. The financial markets don't sleep, and therefore, especially if you're doing an IPO, you don't sleep. One of the most important things is this: because of the travel involved, markets are open. Some market is open somewhere at any point in time, and therefore you're on all the time, especially if you are doing an IPO, and especially if you're traveling, and especially if you have clients in different countries. Therefore, the hours are unpredictable, but it is an extremely lucrative, both financially and from perspective of fun. It's a great fun job to do, yes, and I think essentially that is all we have time for now. I do have time for questions, so if anyone has any questions, please let us know. I'm here for another 10 minutes. We have some questions here, so I'm going to... What is a boutique investment bank? Very good question. So boutique investment bank is a bank like a Vendors Capital, MAPE, O3, Lazard, Rothschild. Boutique investment banks are investment banks that primarily focus only on M&A they focus only on investment banking. They focus on M&A and fundraising. So they will help companies buy other companies. They will help companies sell companies. They will help clients raise money, both private equity and public, from the public markets. What they don't do is all the other stuff. So they don't often do any, they don't actually run the IPO in terms of, sorry, they don't have trading houses, they don't do brokerage, they don't do any commercial banking, they don't do corporate banking for that matter, they don't do any retail banking. So, you know, obviously they don't do retail banking. Essentially, they do only M&A and fundraising. Apart from modeling and analytical skills, what other skills are required? Apart from modeling and analytic skills, what other skills are required? Are you talking from, if you're talking about so I divide the skills into hard skills and soft skills. Hard skills, you need to know finance. You need to know your numbers, you need to know accounting, you need to know valuation, you need to know general understanding of economics, macroeconomics and microeconomics. You need to know what country risk premium is, for instance. You need to know what is happening in the world and need to be able to connect, and of course, financial modeling and being able to storyboard, etc. These are your hard skills, right? So this is the crux of it. Which is essentially, for all practical purposes, corporate finance. Okay, corporate finance. The soft skills are Excel, PPT, negotiation, persuasion, connecting the dots, being aware all the time, being very resourceful, because a lot of the time the numbers aren't available, the people aren't available, you get shut down by clients. But essentially, I think the most underrated quality that it takes to make a good investment banker is persistence, because you're not going to be a good investment banker if you don't get the deal. And getting the deal is persisting after to get a client, making sure you actually get clients that help you run deals. Because if you don't actually pitch properly and get a client, which means calling day after day, being persistent in tracking that PE firm to invest in your company, being persistent to track that client to make sure that he comes to you to do the deal. Consistency is a quality I think is highly underrated. I don't have an MBA. I'm presently doing FAP course. How important is an MBA? An MBA is important if you want to be an associate. If you are willing to do an analyst position and you can prove to them that you have all the knowledge, you don't need an MBA to be in investment banking. Just a BSc graduate, how to start a career in investment banking. Do the FAP program, EY FAP. Which will give you an understanding. One of the issues these days is because there are so few jobs and so many people, it's cracking the interview. And I think a program like the EY FAP course helps you crack that interview, because it gives you the base knowledge that will prove to the investment bank or the interviewer that you're going to add value from day one. That's what you want to prove to them. That's what the interview wants to see. The interview wants to see that you will come in and you need to be able to put together a financial model. You can put together a profile. You can read an annual report. You can do financial analysis. You can value companies properly, and we teach you that in the FAP course. And if you can prove to a banker during an interview that you can do that, you're going to get the job. Can you suggest some pure ID websites that? Okay, so here are some websites to help you. The first thing you do is you go to Google and do make sure that you have they have Google alerts, investment banking, corporate finance, M&A, and that will keep you abreast of all the deals that are happening. In India, you have something called VC Circle that tells you all the deals that are happening. Deal Tracker is a global website that will tell you about all the deals that are happening. But apart from that, Economic Times will tell you what's happening in the markets. As an investment banking firms trade on equities, or well, if it's a bulge bracket firm, they do everything. Equities, derivatives, fixed income, commodities, they trade in everything. Yeah. How many months does a non-finance average student? Oh, well, I think if you do the EY FAP course, it's going to be 3 months. So there's no such thing as how many months does it take to. I think you need to work hard and spend time studying. If you manage to complete the course in a good amount of time, which is I think 3 months, and you spend a lot of that time actually studying and telling and doing what we tell you to do, especially during interview prep, which is quite hard. That's pretty much what you need. But I think it's important to understand you need to be interested in the sector, which means you need to watch CNBC, NDTV Profit, read the paper, all on the side so that you get into, because if you're not in finance, then you need to get into the environment that helps you appreciate it better. Yes, absolutely. Start your career at a small firm. Will you learn more? 100%. You will learn more You will learn more about what you do at a boutique investment bank because you are given the opportunity to do more. But at a boutique, you will only get exposure to M&A. You will not get exposure to anything else. If you work for a bulge bracket like SCSA Securities, because you're working as part of a larger group, you will get access to a lot more divisions. You'll get more exposure, but you might not learn your skill very well because you're not doing a lot of it all the time. I'm excellent with numbers and analytical skills as an engineer. How would I persuade an interviewer? Honestly, you need to know what investment banking is. There is absolutely, yes, you can talk about or logic, you can use logic, but the problem is there are so many people gunning for these jobs now. You have to know a little bit about finance to convince an interviewer to put you, because an engineer that's really good at logic, numbers, and analytical skills also knows corporate finance will have a better shot at getting the job than an engineer who doesn't. So do the FAP program. Yeah. I'm an engineer. How do I become an investment banker? Very simple. Do the FAP program. Yeah. Because you need to understand what finance is. You can do that from books. You can do that with some studying. But you can't, you have to get an understanding of what corporate finance is. And unfortunately, our careers in our graduate programs don't tell you anything. So come here. Yeah, how different is the CFA? The CFA is a hands-off course. The EY FAP is a hands-on course. We teach you how to do everything in class. We hold your hand through pretty much most of it. We ensure you understand it. There's nothing like you just give me assignments and I grade you. I ensure you understand it in class. It's a practical program, so we simulate an investment banking environment. And a CFA doesn't do that. A CFA is just theory. And while it's a great theory and concepts, it doesn't actually teach you how to make a pitch presentation, an equity research report. It doesn't tell you how to do an actual valuation of a private or a public listed company. What is it really like to do that, and how to pitch, and how to put models together and teach you how to model. Yeah, I hope that helps. I'm currently pursuing my MBA, okay, by Delhi. What is your question? We will move on because I don't have much time. When are interviews typically held, and when do IB take applications? Interviews are held, rolling interviews. IB take applications through the year. You would have to call the HR of a particular company to find out more. The online FAP course. What are exit and career progression? Just to keep quick thing, the online FAP course and the classroom course are exactly the same, except that the online FAP course, you can do it from home at your own pace. But otherwise, the webinars is pretty much like this. You have access to the trainer. You can ask them all the questions you want to ask them. You have live classes in the online FAP. So if you're anywhere in the country, you can take this program and benefit just as much as it becomes coming to class. Can we get internships in my first year? Absolutely. In your first year of MBA, but you need to work quite hard. It's contact driven. We suggest, and it's usually given to people who know something about finance, because internships again are very competitive. Yes, but you can do internships, yes. Can you suggest some names of firms or where? Of course, so many firms. VC Circle. So obviously, if you go to somewhere like VC Circle, you get the league table of who the banks are. But great banks, bulge brackets. You have many Indian bulge brackets. I said every Indian bulge bracket will have some sort of small M&A team. Please note that M&A is also done by corporate finance firms, like in corporate finance teams of large companies like Tata, Reliance, Mahindra and Mahindra. They will have corporate M&A, internal corporate finance teams that do M&A because they really don't want to go to investment banks. That's also a great place to start. But generally, just Google. Names on the top of my head, I see any major investment, ICICI, Edelweiss, HSBC, JP Morgan, Goldman Sachs, Citibank, Standard Chartered, Indian, Avendus, MAPE, O3 Capital, Cypher Capital, Sprout Capital, so many. Google is your friend. Practice. Numbers are, everybody's good at numbers, in my opinion. I mean, if I can do numbers, anyone can do numbers. Practice, and when you do that, you do a program like the FAB program, or an online or a classroom, which will help you practice and get familiar with numbers so that they're not that scary. There's no such thing as you're not good with numbers. There are only 4 things you need to do in finance: addition, division, subtraction, multiplication. You can do that, you're good at numbers. You have Excel. That does everything for you. You don't need to be good at numbers. And may I know your name, please, that I can show you? My name is Reshma Krishnan. Yeah. When does the online EY FAB start this month? I think the online EY FAB, there is a batch that's starting day after tomorrow. So please contact. They will take your name and they will contact you immediately. And they'll let you know how to start the program. It starts on Saturday, it's the launch, and the first class is the following Saturday after that. Can you suggest some names of small firms that accept graduates who've done this? I have just said the names of the boutique investment banks. So thank you so much for attending. Great to, there will be a poll now where they'll ask you how much you enjoyed this ending. And otherwise, I hope to see all of you, at least some of you, in class, online or offline in classrooms in the next few weeks. Thank you so much. Bye-bye.